Hello, everyone. Salim Omar here, President of Straight Talk CPAs. Today, we are going to be talking about S corporations. And in specifics, we're going to be talking about building wealth and saving on taxes using the S corporation. I'm joined by my tax advisor at Straight Talk CPAs, Sabir. Sabir, welcome.
Thank you, Salim.
Looking forward to our chat today about the S corporations. What is an S corporation? What are the key benefits? And why choose an S corp over other legal structures? It's one of our favorite ways, Sabir, to help small business owners save money in taxes. So I'm really kind of looking into getting some nitty gritties of what the tax savings are and some of the other benefits that come from having creating making the business entity into an S corporation. So there's various legal structures that one can operate in: sole proprietorship, LLC, which is it can be a single member, meaning one owner. It can be a multi-member. You can operate as an S corp. You can operate as a C corp. So why an S corp? Sabir, talk to us a little bit about what the structure, what does an S corp mean, and what are the requirements?
Sure. So first thing is S corporation is not a legal structure, so that's not an entity to be formed with the states. So that's an S election that a person has to do with the IRS. So first you can form either a single member LLC, multi-member LLC, or a sole proprietorship. Then you can do the S election with the IRS. Now the first benefit and the most beneficial thing about S corporation is it saves self-employment tax. So if you are a single member LLC, multi-member LLC not doing an S election, they have to pay the self-employment tax at 15.3%. So that comprises of 6.2% of a social security and Medicare 2.45%. So that combines up to the 15.3%. So it saves FICA and FUTA taxes portion there when we do the S corporation, but it has some another nitty-gritties which we can dive deeper into in upcoming slides.
Okay, sure. Talk to us about the requirements of, can anybody be an S corporation?
Yes, I mean, any legal structure can file for S corporation, but the thing which we have to consider the thing which we need to careful about are the owners. So there must not be a foreign owners, and the class of stock must be single class of stock. So it does not have to be another preferred stock, because that create a second class of stock and throws you out of the eligibility of the S election. And the maximum number of shareholders can be 100. It cannot go beyond that.
Okay, all right. So you got to be US based. You got to be, the owners have to be US, in the US residents, citizens. Yeah, you cannot be a foreign owner. Correct. To have an S corp, a single class of stock. Most small businesses are one class of stock, right? And most small businesses have less than 100 shareholders. So meeting the requirements for the most part is quite achievable for most people, yes. Right?
Absolutely, yeah.
Got it. Next slide is talking about double taxation. Sometimes when we meet with a new client and they're like, Salim, I don't want to get double taxed, and I've heard this thing about double taxation. Talk to us about what that is. Is an S corp? Is there double taxation in an S corp?
No, S corporation is not a double taxation. Reason being, it is a pass-through entity. So whatever you have earned at S corporation level, it will pass through on your personal tax return, and you will be paying taxes at a personal level. So for double taxation, it's a C corp, where the person has to pay a flat rate of 21% on C corporation net income. And then when a person take a distribution out of it, then it is termed as a dividend and have to pay income tax at a personal level on that distribution as well. So that's a double taxation for C corporation, but for S corporation, it's a single taxation only.
So for the S corps, you can get into between paying the C corp paying the tax, and then the personal, the owner paying the tax. That can go to like 40-50% with the double taxation. And with the S corp, with the pass through you just mentioned, the entity does not pay the tax. It flows onto the owner, and the owner pays the tax.
Yes, owners pays the tax. So that's a single taxation.
Right. Yeah. 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 Good. And that's, yeah, saving money. This is how you save money, folks. Single level, single taxation level, and then self-employment tax. And we'll share with you guys a few examples of where the saving comes in. And, we've got here on the screen an example where the net profit's 200,000, and the owner takes a salary, a reasonable wage of 80,000, takes a distribution of 120,000, and the potential tax savings is 10,000 in payroll taxes, which is self-employment tax. Sabir, you mentioned you gave the 15.3%, which is FICA and Medicare
Yeah.
tax, right? That's the
Yes.
saving
Yeah.
in this
That's it.
example.
Yep.
Now, is the savings more or less as we go in a different tax bracket? So let's say this one's 200,000. Next slide, we've got a business that's making $100,000 profit. Is there any benefit of becoming an S-Corp with $100,000 profit?
Yes, so that's percentage saving would remain constant. So, I mean, higher the net income, higher would be the saving on that amount, because you'll be saying again 12.4% on social security and 2.45% on Medicare taxes. So, higher the income, higher would be the saving there.
But with a $100,000 profit, there's going to be a saving of some $6,000. In the previous example, the saving was $10,000 for a $200,000 profit.
Yeah, so there is a limit in a social security, because social security applied up to the maximum 168,600. So above certain amount, you will not be saving on social security, because they will not be charging on a social security. So then above that amount, only 2.45%, 2.9% you would be saving on a Medicare taxes only.
Got it. If we go higher, and I think the
Yes.
next example is a profit of $400,000. $400,000 profit, take $120,000 salary, take $280,000 as a distribution, and there is self-employment savings on the distribution part. So you're going to save the 12.4%, and then you're going to also save the 2.9% on the Medicare portion, right?
Yes. So now you are already paying social security on 120, so that's on a salary. Now out of that 280k distribution, you will not be paying social security on the entire 280, because there is a social security wage limit of 168k approx amount.
Right.
So you will be only paying social security on the remaining amount, and yes, you would be saying 2.9% on the entire 280k.
Right. Yeah. And so that's a fair amount of savings, isn't it?
Yes, when we compare it to the cost, then that's a fair amount of saving, because doing this extra, doing a selection, taking wages, so that cost would be lesser, because that's way less than 20k. You would just have to file an extra tax return and payroll taxes. So that is the cost for you for doing a selection. Now benefit is 20k. So yeah, if you do cost benefit analysis, even 20k is way more for saving.
Yeah. Yeah. Cool. I'm wondering when does it not make sense to form an S-Corp? Before we go to the next strategy.
Yeah. So again, the cost benefit analysis, let's say if you have a 10k profit and you are doing an S election, so that 10k would save you 15.3%. So that's hardly 1,530 tax saving there on 10k. Now, if you file S election, if you do payroll taxes, so that's benefit would be offset by the cost you would be paying to your tax professional for filing that extra return and filing payroll taxes. So like if your benefit is more than your cost, then it makes sense. So that would be somewhere around 50k net income. So once you have 50k over and above that net income, you can do a selection and save a significant amount of taxes there.
Got it. Cool. Yeah. So 50,000 is the magic number that we like to work with when we're talking to a startup, somebody who's, either they've just started or they're, kind of at that mark where they're crossing over the 50,000 is when we start having conversations about doing the S election, getting them set up with reasonable wages, distributions, estimated tax payments, payroll. So it's all kind of, set up so that they can save money on self-employment tax. Very cool. So that was kind of strategy number one, self-employment tax savings. Let's talk about strategy number two, maximizing profits through retirement planning. What does that mean for an owner of an S-Corp that's elected to become an S-Corp, sees themselves saving $10, $15, $20,000? What do they do with that money?
Yes, they can. I mean, it depends on their investment strategy. So, if they want, they can deposit it to the retirement account, and they can keep it there for long-term plan and take it as a qualified distribution. Because once you do the retirement contribution, you cannot take a distribution before the specified period. So, yep, they can keep that amount into the retirement accounts and enjoy the tax-free savings if it's a Roth, and if it's a traditional, then they can take a benefit of the tax bracket between now and the future, whatever their expectation are from the economy.
So what you're saying is save money on taxes, channel those funds into a retirement account, right? And if it's a traditional, that's an additional tax deduction, isn't it?
Yes. So if they are contributing to the retirement account, let's say solo 401k, so maximum contribution can be 69. That's comprises of both employer and employee. So here
$69,000. So they're getting 69,000 as a deduction.
Yes, as a
Their
deduction on
tax
S
return.
corporation tax return.
Okay.
Yep. And they can contribute. So here the person himself, the owner himself, would be contributing as an employee and as an employer. So
Right.
again, he can keep aside this 69k and take a deduction on the S corporation tax return. So that's a double benefit there.
And then, of course, that money is growing tax deferred. So the
Yes, that's money
69,000 year one, 69,000 year two, 69,000 year three, it's all growing tax deferred. There's no tax bite being taken out. So that whole amount is growing. So that's like
Yes.
another benefit of this compounding over the lifetime of that investment fund.
Yes, over the lifetime of an investment. Yeah, that's a tax deferred account. These retirement accounts are.
Right. Yeah. That's awesome. Yeah. So that's strategy number two, folks, is channeling the funds that you're saving on self-employment tax, channel that into a retirement account, get the contribution as a deduction, and then grow that contribution on a tax deferred basis, right? If it's a traditional, if it's on the Roth side, if it's a Roth 401k, then that money is growing tax free. So that's a substantial saving there. All right. Last few minutes, strategy number three. Talk to us about that.
Yes. So, like for tax deductible expenses, the leveraging the travel and business expense. So a person generally goes to the personal trips as well and business trips. So they can take a deduction for those business travels. Now it doesn't have necessarily to be organized as a business travel. So let's say a person went on a personal trip and there he finds some conference to be attended, then he can attend the conference related to his business. But make sure that you pay that amount from your business checking account or business bank account so that you can take a deduction. You can take a reimbursement as well under accountable plan, but I mean, the less complicated we make it, it would be beneficial. So, yep, that's a business expense, traveling expense. You can take a tax deduction for that. Then you can arrange a board meeting, and whatever expenses you are incurring for arranging those board meetings, you can take a deduction for that board meeting as well.
Right. Yeah. Many times, entrepreneurs, business owners, they take trips and they're not getting the full benefit of that. And if they can structure it such that it can be a business, right? It's tied to the business. There is a board of directors meeting. There is a meeting agenda. Perhaps they are their family members that are part of the board, right? That are attending, and instead of now it being a family vacation with zero deduction and no tax benefit, you can convert a portion of that into a business deduction.
Yeah.
And that, yeah, that's one of the tax strategies that we like using for helping our small business owners is, the board of directors strategy as well. Awesome. Now, this is one of my favorites. I've kept it last. Last but not least, when it comes to children, uh, adding your kids to the board and putting them on payroll. And there are substantial tax benefits of shifting income and taxes from you as an owner, most likely in a higher tax bracket, and shifting it to your kids that are in zero to low income tax bracket. Give us some numbers, Sabir. You work with clients day to day with getting their kids on payroll. What are some thresholds? What are some, what are the benefits here?
Yes, so the benefit is when you pay a wages to your children that genuinely work for your business, and that business can be anything like admin purpose, arranging file cabinets, or making drafting, anything related to your business. So you can pay them, and you can take a deduction for those expenses on S corporation tax return. Now it will be income for the children, but they will not be paying any taxes, because we just have to make sure that we are paying them below the standard deduction which they are getting on the personal level. So if right now the standard deduction is somewhere between 13 to 14K, so you can pay that much of amount, and they will not be taxable to the children, because that's below the standard deduction limit. So take a deduction on your S corporation tax return and does not pay anything on your children. So that's another benefit of having a business setup.
Okay, so up to 13,000. So let's say you employ your kid, your child, they're on the board, which means family trips deduction, or give them duties, admin, digital staff, website staff. Let's say you pay them $12,000. So you're saying the business owner gets a $12,000 deduction. The owner,
Yes.
the father, the mother, they get a $12,000 tax deduction. If they're in a 50% tax bracket, they're saving half of that in taxes. The child gets that income and pays no tax, because standard deduction is going to zero out that income.
Yep.
Got it. Yeah, yeah. What does the kid do with that money besides spending it? Like, is there a way? What do you do? Spend the money, or is there opportunities to invest it?
Yes, definitely. I mean, there are various accounts like Roth IRA in which they can deduct, because they do not have to invest in a traditional IRA, because they do not need a deduction on your personal tax return, because they are not required to pay any tax. So they don't have to deposit in a traditional IRA. They can do deposit into the Roth IRA and earn income on that as not a tax deferred but a tax free, if it is a qualified distribution after reaching at a specific age limit, and keeping the amount in the retirement for a specified time period. It can grow a tax free, and yeah, so that's the benefit of Roth IRA as well.
Yeah, yeah, cool. And yeah, I guess we talked about this earlier. Is an S-Corp right for everybody? So 50,000 is kind of the threshold when it comes to, if your business is making a profit of 50,000 and over, you definitely want to consider converting your LLC, single member, multi-member C-Corp into an S-Corp. And it's best for service-based companies without heavy reinvestment needs. And so, yeah, those are some things to do. And of course, what are your financial goals? Are you going to be looking for money, outside money, so forth? So different things that play into they need to be considered as well. Business structure, long-term planning, setup and maintenance. To convert an LLC into an S-Corp, you've got to file Form 2553. There's a deadline for that, so make sure kind of you do it within the time frame. And then corporate maintenance, importance of accurate bookkeeping, paying reasonable wages, and then regular reviews, salary evaluations, and then tax planning. So once you become an S corp, that doesn't mean now you can kind of free will it. You got to do things in a certain way so that you're compliant. Mistakes to avoid: IRS red flags: not paying a reasonable salary. You can't go too low on salary. But you don't need to go too high on salary as well. From a record keeping standpoint, clear documentation, distributions, and we talked about foreign ownership, not allowed, or multiple stock classes. Making it work for you: regular consultations with your CPA, compliance, proactive tax planning, year-end planning, maximizing tax benefits through strategic planning. Sabir, let's finish off our discussion today about S Corps. We talked about 3 specific strategies: self-employment, savings. With becoming an S Corp, we talked about the investment, channeling those funds, those savings into a 401k. And then third one was utilizing the family board of directors system structure so that you can write off expenses that typically you may not be deducting. Any final thoughts, comments before we finish off?
Yes. So, so the most important thing would be the reasonable compensation. Now, IRS hasn't define anywhere what's reasonable, but yeah, what you would pay to a person to do this job the same you are doing, so that's a reasonable compensation. So that's a thing, that's the careful thing we need to keep in mind. Now, if you are putting your children on a payroll, then make sure you are issuing the W2 wages to W2 to them and filing the payroll return for them. So those are from the nitty-gritties from the compliance point of view. Apart from that, if you have a net income above 50K, I think you would be at a better position to save a few dollars there.
Yeah, more than a few dollars there. Yeah. Thank you, Sabir. Appreciate it. Folks, hope you found this valuable and hope to talk to you soon. Take care. Bye.